Hello, everybody, and welcome to this week's podcast for the week of February 12th. We are recording this on Wednesday. Now, we typically record on Thursday, released on Friday. We're still going to release this on Friday. So, for those of you listening, happy Valentine's Day from the crew at Dorsey, Wright. But I'm joined here by Joseph Tizzulo, good friend and colleague. I think this is our first time on, isn't it?
I think together, yeah, I think it is our first
I
time.
know, pretty cool. So
Yeah.
we've got a couple things on the docket where we've got Tuz in today specifically to talk about a really cool piece that he put in the report that's probably applicable to a lot of you all listening, talking about buffered products within your portfolio, some of the statistics behind them, how they work, maybe some pluses and minuses of buffered products and things along those lines. And then, of course, just getting through and talking about some of the technicals. So why don't we start with that? Sound like a plan?
Yeah, for
And
sure.
how markets did over the course of the week.
Yeah, I mean, markets were pretty much flat over the past week. Obviously, we had some hot inflation data this morning.
Right.
We'll see how that shapes up by the time this comes out. We could be up or down 2% from here, so who
Mhm.
knows? But uh, overall, the data was pretty hot. Now we'll see if it was a short-term thing. One of the things was like egg prices were up 15%
Right.
month over month or something like that, which you know that's more of a supply issue than a demand issue, which I think a lot of the inflation that we've seen over the last couple of most of the period was more demand driven than supply driven.
Yeah, I was seeing a funny, like it was a meme or something like that, and it was like, wife isn't happy with me. I just put my bonus into eggs, and he just opened it up, and it was like whatever it is. So there's definitely some of that and everything like that going on. But yeah, like you said, we're definitely gonna have to keep an eye out on everything. Of course, there's some tariff concerns people have cited. Maybe tariffs are inflationary. And of course, the higher inflation is, the kind of the longer rates, or that the kind of the stronger the higher for longer argument becomes,
Yeah.
which is going to be possibly a headwind for the equity space in general. Headwind for a couple of different spaces. Gold, precious metals are impacted negatively when rates are higher, kind of that opportunity cost, which we've talked about before of owning precious metals goes up when rates are higher. Of course, there's the basic relationship of when rates are higher, bond prices are depressed as well.
hmm
So it impacts a lot of different parts of your portfolio and definitely something to watch. I'm just rambling now, but
Yeah, I mean the tariff thing is really interesting because I think the risk profile for those is pretty wide, right? Like we don't necessarily know if the tariffs are enacted, how that will necessarily affect the economy. Obviously, you would expect prices to be increased somewhat, right? But we don't even know the degree of those tariffs. Obviously, it's being used as a bargaining chip at this point.
right.
Whether they like follow through with it, if the other, there's no deal to be made, type of deal is yet to be seen. I do think they would follow through with it, but obviously they're always open to negotiations,
Right.
and a single tweet or comment can really move markets. Um, so, which it's kind of exciting because some of the low vol periods can get a little bland.
Right.
But yeah, so we'll see how all the tariff news, the hot inflation data, how that shapes up over the next couple days and weeks. Really, over since the start of the year, we've kind of been in this big consolidation range on some of the bigger indexes that we keep track of, which is really what I'm focused on right now. If you
Hmm.
listen to our weekly video, which will come out, will have come out by the time this podcast has come out, but we walked through a couple of those mega cap charts,
Hmm.
like XLG's kind of traded sideways for the last couple of months. IWM, except for that big bump up it had in November last year, pretty much traded sideways since August.
Right.
So I think we're building a lot of energy in this range, and we're gonna once it's released either to the upside or to the downside, I do expect some kind of substantial move
Right,
out of
because
that range.
essentially the kind of the conversational way this works is, bulls and bears essentially set their, you think about warfare, right?
hmm
And they set their lines and they set their trenches and they're entrenched at those points. The maybe, further or longer that you consolidate or fight around those specific trench lines, the more explosive it can be
Yeah.
in either direction. So again, no guarantees either way, but that's kind of the way that the conversation works around those points.
Yeah, for sure. And I think
So
that's the main thing to watch from a technical standpoint on the indexes right now from just a pure price action
yeah.
perspective.
Certainly. Now with some of that, maybe we can use that as a parlay into our next part of our conversation is, possibly if things do start to swing around a little bit, there are products that have hit the line quite hard over
Yeah.
the last year or so that are buffered products. Now, when we say buffered products, we talk about defined upside, defined downside type of deal. And I'll let you, since you've got the data in front of you and you did some of the testing, I'll let you kind of jump into your stuff. But why don't we start with your definition of what a buffered product is, how it functionally works, and then maybe we can jump into the numbers behind it.
Yeah, so I use defined and buffered products, essentially terms interchangeably for the same type of thing.
Right.
Really what they're trying to do is they're trying to limit some type of downside at the expense of capping upside to a certain extent. Now, the buffers vary widely. You'll see like there's deep buffer ETFs, there's like close buffer ETFs, there's they have it on equities, fixed income, they even moved it over to commodities now.
Mhm.
And obviously, the reason for these is to have it as a risk management tool. Essentially, the selling point is, hey, you can still have conservative clients get exposure to equities while still keeping, that conservative risk profile with the downside protection.
Right.
Now, these products vary wildly. Now, the traditional kind of first buffered ETFs or defined outcome ETFs were like, we'll protect you between 5 and 12% of the downside, and we'll cap you at like 10% upside or something like
So
that.
I'm gonna stop you there, and just for the listeners, define what that means. So if you have, let's just say the market is up 20%, right? You are only going to participate up to that 10%. If the market's up 5%, you're going to participate fully because the market was up 5%. Now, in that scenario, right, where you said you're going to be protected from the first 8 to 12, if the market is down 2%, what happens? You're flat?
Well, it depends. Sometimes there's like a range. So it's like you're protected between a 5 and 12% drawdown. So you realize the first 5%,
Okay.
and then you're hedged between that 5% drawdown and the 12% drawdown on whatever index
Right. Okay.
we're trying to track. Now, there's a lot of other different products nowadays too. So there's some of them where it's like you get, 5% downside, but you get capped at 10% upside type of deal. They can even be wider than that type, sort of thing. Um, but the general, I think we kind of figured out like, okay, the defined or buffer products, what we're really doing is we're trying to manage our risk profile by eliminating some of the downside, whatever that is, at the expense of some level of upside,
Right.
whatever that is. And it varies widely between different products and providers.
And they're able to do this. We won't go into the details. They're able to do this via different, options,
Hmm.
overlays, and things like that that essentially have different payoff structures for the different contracts that these issuers are or how the fund is set up, if you will. Pardon me there. But yeah, so that's the idea, and they've evolved, right? Like you mentioned, the first edition was, you still had some downside. Now there's products out there that you're getting no downside, which seems too good to be true.
Yeah, I mean, so you're getting like no downside, but I mean, obviously your cap's going to be pretty low
Right,
too, right? So, or it's like there's a very small level of downside and, the
right.
capped upside type
Put
of
that
deal.
in reference. Is it like 5%, 8%? What does that look
Again,
like?
there's so many. I think there's over 200, there's almost 250 buffered ETF
Okay,
products out there nowadays. So there's so many, it's hard to like say, oh, this is like definitely one
right,
type of
okay,
deal.
yeah,
Um, but um, I think at the end of the day, you're paying for this defined outcome. Now, I think the first thing I wanted to address was, does that really, is that the best vehicle to do that? If you're trying to manage your risk profile, is it the best to give up your upside past a certain point while hedging against a certain amount of downside? And then the other thing is like, is this, uh, kind of worth the expense? Because usually these products carry somewhat high expense ratios, relatively speaking, for the
right,
exposure that you're getting. Um, and I think when it comes to, I mean, there's a place for the buffered ETFs, but I think the selling point, it's a really good story, right? It's like, oh, you get to participate in equities, but you're also protected on the downside. I think you can either do the same option strategies yourself. If you didn't want to do that, could just do the traditional risk parity type of trade where, you have equities and then fixed income, and the fixed income balances out the volatility from the equities type of deal.
Right.
Uh, so in this very basic test I ran, we looked at the S&P 500, and I assumed you were able to put in a zero cost collar where the call was 10% out of the money that you sold, and then the put that you bought was 10% out of the money. So you're hedged against all downside below 10%, but you're capped upside of anything greater than 10%. So the most you can gain in a year is 10%. The most you can lose in a year is 10%.
Right. Okay. Which, I mean, in some of these products, like you said, I mean, they've got even smaller collars than that set up. But, for those of you listening, essentially what that's going to say is you're going to participate up to the average year, right? The kind of the more near term average is about 8 to 10% a year in terms of equity markets. So I think that's a practical test that you ran. So run through, I guess, some of the
Yeah.
findings.
So I also compared it to a portfolio where you just buy and hold the SPX. Obviously, that's going to do better,
Right.
right? Then where you just own money market. So there's good. The yield on that is going to vary over the test period. We look back from 1990 until
Okay.
through the end of 2024. So you obviously get the zero interest rate policy environment where money market's essentially yielding nothing, right? And then I did a split of 50-50 SPX and money market, that portfolio, and then that buffered zero cost collar
And
type of
those are
deal.
your two main comparisons. I mean, those are like the more realistic things of like, hey, you could either be in the buffered product or you could be in maybe a 50-50 split of pure market and cash,
Yeah,
essentially.
yeah,
Right. Yeah. Okay.
exactly. So over that entire period, money market has a cumulative return of just under 150%. Um, the buffered ETF hypothetical strategy has a cumulative return of 340%. So better, right?
Right.
A 50-50 split between the S&P 500 and money market has a cumulative return of 640%. So I would say that's like you know, from a risk standpoint, that's fairly conservative for someone that really wants exposure to equities type of
Right.
deal,
Over the last
you
30
know,
years, that is.
over the last 30 years. Now, one thing I wanted to look at too was this notion that you brought up of like the average year in the S&P too, right? Um, so if you look at the SPX by itself, the years it was down more than 10% over that period, um, you know, year into year end, it was down more than 10% 5 times. It gained more than 10% 19 times.
Wow.
Now we're looking at like a pretty strong bull market period for the most part.
Right.
Obviously, you got 08 and 09 in there. I mean, 2000s weren't great, obviously, but you still have pretty much from 2011 till now, which
Right.
has been pretty strong run with some bumps in the road. Um, Now for the buffered product, obviously you have no
No
years
years
down,
less than
no
10.
years
Right.
worse than 10%, and no years better than 10%. Which that's yeah, the S&P did way better, but I had a hold through 2008 and 2009. I had a hold through 2000.
Right.
That was
Interperiod
one.
experience is something we talk about, which is going to be when I get there, my counterpoint to you eventually. I'll just throw that
Yeah,
out
yeah,
there.
yeah, yeah.
But go ahead, continue. Don't mean to interrupt.
No, so then like for the 50-50 split of SPX and money market, obviously money market had no years
Right.
below 0%. Its best year was um, 700, 762 bips. But for the 50-50 portfolio, you're only down more than 10% 2 times since 1990, yet you gained more than 10% 14 times.
Hmm.
Your worst drawdown or worst year, excuse me, was you were down 18%, and then your best year, you were up almost 20%. So just using the traditional kind of risk parity type of deal, using short duration money market funds to manage risk, and then have the rest in uncapped equities, which I think is the most important part. When you have your equities exposure, you really like the biggest benefit is the uncapped upside
Right.
for owning equities, in my opinion. When you look at something like the buffer product as well, you also have to think about what can I get above cash from this product. I can risk 0% and I can go buy a 1 year treasury. I think it's at like 4.2 right now,
Right.
right? So essentially I can have a risk-free return of 4.2%. In the buffered product, I'm risking 10% to get less than 6% above the risk-free return.
Right. And the math for those of you at home, that's the money market yield. Uh, and the difference between the money market yield and the cap in this scenario at 10%. So that's that 6% spread that Joseph's talking about.
Yeah. So from that perspective, you're risking 10% to make 6% above cash, possibly
Right.
above cash, uh, which I think that's where it really becomes detrimental when you think about it. What is my investment versus the risk-free rate, or what can I get for nothing, essentially no risk? And then as I take on risk, what do I get? And that negative, I think, risk return profile, even though it's still you produce positive returns over time, just because equities tend to go up,
Right.
right? Um, I think that's really the biggest detriment for a lot of these defined outcome ETFs. The second point, one of the big selling points for these things is like, oh, you get to participate in the average return of the S&P, or whatever market you're looking at over that period, right? They typically refer to the annualized return of like 8-9% or
Right.
whatever, right? Now, since the buffered products reset, we're just going to assume it's a annual reset at the end of each year.
Sure.
In this case, which is a lot of those products, they have monthly versions, right? So it's like April to April or
Right.
June to
Right.
June or
Right.
whatever. I just assumed it was going to be like the end of December to the
Sure.
end of
Year to
December
year.
next year.
Yeah.
Exactly. Um, the average S&P return, uh, the average annual return was 9.84%, like average annual return, not annualized
Right.
return, because these products reset annually. That's really kind of what matters in this case, right? Um, so you say, oh, that's fantastic. That's essentially where the upside cap was in this hypothetical buffer ETF product. Um, Now, there was only 7 years where the S&P had a return between 4.84% and 14.84%, which is essentially uh, plus or plus or minus 5% from the average annual return. So the average annual return in the S&P is rarely actually what happens in a year
Right.
type of deal. Typically, you're getting
Right.
something
There's something better than that,
you're
or whatever.
it's either up more than 10% or it's you know
Right. And the average, it's never
it's
nine.
never around it's
Right.
like
Yeah.
almost
Yeah.
never around the average. So I think that selling point for these is like, oh yeah, you get to participate in the average annual return or the annualized return of the S&P. Isn't necessarily true when you break it down year by year and
I
you
see
start
what
to
you're saying.
look at the distributions of returns over those years.
Yeah. No, I mean that's a really good point. Now there are. Do you have another one? I don't want to just cut
No,
you
go
off.
ahead, go
Okay,
ahead.
because my idea, and listen, I understand the numbers are the numbers, right? And it's a really good study. The part that keeps me interested in these products, one, it's a massive market, right? So they're already,
Hmm.
maybe you would say, maybe they're here to stay, maybe it's a fad, who knows? But what we've learned is one, there's no such thing as a free lunch. So what are you paying for, right?
Hmm.
And you are paying for the defined outcome, right? And so like my kind of definition of yes, we know that if you're over a 40-year time horizon, these things aren't going to work.
Hmm.
Or maybe they're not, I won't say they won't work, but maybe they don't keep up according to your study with just owning the market or
Yeah.
even just owning a 50-50 split, right? But you have to think about, maybe in, a 1 or 2 year period, maybe it makes sense to pay for that defined outcome because at the end of the day, all we're doing is just trying to stay invested. Um, that's what works over the course of time frames. And so, you are paying for it, but if you can look at yourself and go to sleep better at night because you know that you're not participating in a 2008, a 2009 type of scenario, maybe it's worth it. I don't know. That's where I get hung up on this stuff because I would say, yeah, of course, right? Everybody knows it doesn't pay to cap your upside over 40 years.
Yeah.
But if you can go to sleep for a lot of retirees who want some exposure, but they really don't want to mess around with it. Now, I know that's your 50-50 money market split. I know
Or
what
like
that
whatever
is.
split like you
I
wanted
know.
to do
I know.
type of
And
deal.
that's your argument against it.
Yeah.
But I would still say that there's some value in being able to sleep and saying, I'm not going to lose more than 5% here. I
Well,
don't know.
I think that's like part of this was so people have a better understanding of what the payoff structure for this looks like over time. Now, there's going to be specific use cases for
Right.
this where I think it could be applicable, right? Um, Now, at the end of the day, most of our audience is financial advisors, and they're getting paid a fee to you know um, give advice to clients and
Right.
manage their money and things like that. Which I think at the end of the day, the advisors can do just as good of a job without having to pay the higher fees for some of these buffered ETF
It's
products.
fair. Also
Now,
fair.
I think you made a good point where there are use cases for it, but you should understand that you are giving up a lot to
Yes.
for the defined outcome.
Right.
It's all operates almost like an annuity somewhat. My grandparents had a lot of annuities, but
Right.
like nowadays, like annuities, not um, people don't usually view those as favorably as they used to type of
Right.
deal. Now it's going to be different. It's going to vary from client to client. But and obviously no one's going to hold a buffered ETF for 34 years. That would be like kind of the argument against this study or whatever,
Right.
right?
Right.
But I think it really kind of gets into it where you start to look at how the market returns are on a year by year basis compared to what these buffer products are built around.
Right.
Which I don't think is really what you expect in the equity market to actually happen. When they're using like long-term averages, annualized returns, you're saying, oh yeah, usually we get 8% a year. Like you rarely actually get an 8% return on the S&P in a year.
Right.
Like it doesn't happen that often. So, you know, especially for our financial advisors, we talk to them all the time. Like I think they can do a better job than the buffer products. They can save their clients money and add value as well from
Right.
that perspective, which I think is, at the end of the day, I think that's part of what we try to do, especially from a research side of
Oh, of
things.
course. I mean, information is power, right? And
Yeah,
when your study, like you said, there's going to be specific use cases for this type of stuff. We're definitely not going after the buffer market, right?
yeah.
But do understand as we kind of wrap up the call, do understand what exactly you're getting yourself into using studies like these, information, knowledge, like I just mentioned. Knowledge is power when it comes to this type of stuff. Whether you are managing your own money, whether you are doing a duty for a client, managing their money, knowing exactly what's going into the products that you're buying is sometimes more than half the battle. So yeah, that would be my point. Do you have any closing thoughts, I guess, on that before we, I guess, wrap it up?
No, I don't think so. But yeah, I mean, there's going to be more and more products that come out like this
Right.
as active ETFs have become more commonplace in the market. A lot of option stuff um, that seems kind of pretty exotic. Some of the stuff is so. Again, like you said, I think it's really important to understand what you own and kind of how they operate, especially over time.
Speaking of what you own, I've been looking at it this whole podcast. I love this sweatshirt type deal. Where is it from?
I'll be honest, I have no idea. I think it was a gift like a couple years ago, and
I
it was like
mean,
in my closet, and then I pulled it out. Miles just gave me a compliment on it when I wore it a couple weeks ago too.
I know I need to have it.
So
You got any fun plans for Valentine's Day?
no, no.
All right.
Maybe I'll
Well, I
get
mean,
maybe
you
I'll get
better
my
get it going. You got 2 days to come up with
I'll
something.
get my wife some flowers or something.
Get her some buffered ETFs.
Yeah, I'll get her some buckets. Like
Well,
coal in her stock.
yeah.
Get her some buffer ETFs.
Well, listen, it's been a pleasure for those of you listening and made it this far. We appreciate you as always. We'll be back again next week, next Friday to see and kind of touch on market action over the last week. Otherwise, have a good one and keep an eye on the charts.